Hi, I'm Klaus Vogt with Money and Markets TV. Fundamentally, the United States has major problems. The government's budget deficit's projected to hit a record $1.6 trillion this year, nearly 11% of gross domestic product, which is the highest since World War II. Even the Bank for International Settlement, often called the central bank's central bank, has admitted that the current debt policy in the United States is unsustainable. Sooner or later, it will lead to a funding crisis, which will then force major economic and political adjustments. But Europe isn't doing any better. For example, it has become increasingly obvious that Greece's debt problem has not been solved and cannot be solved without debt restructuring. The politicians' way of saying debt default. Moody's recognized that this week and slashed the country's credit rating 3 notches to B1. Ireland and Portugal are in the same boat, and Spain isn't far behind. And what are Europe's politicians doing about all of this? Well, they are pretending that everything is okay, and the European rescue package was a solution to this major problem. But you can't wipe out mountains of debt by issuing more debt. The rescue package did nothing more than kick the can down the road. It bought them some time, but it didn't get them one iota closer to a solution. And for an idea of what's in store, just look at Ireland. The European Union has urged Ireland to implement a severe austerity program, but the Irish population has rejected that strategy by voting in a new government. They know that most Irish government bonds are held by foreign financial institutions and the European Central Bank. So why shouldn't they share some of the burden? Didn't Iceland do relatively well after it defaulted on its debt? Why not follow this easier path? Meanwhile, Greece, Portugal, Spain, and others may be starting to ask the same types of questions. So, over-indebtedness is a big problem for both the euro and the US dollar. But the euro has an additional problem: singular national interests. Repudiating their debt may be in the best interest of Greece, Ireland, Portugal, or Spain, but it is definitely not what Germany and the other relatively healthy countries want. Therefore, agreement about major spending cuts and potential defaults is very hard to come by. The likely outcome of this explosive mix, a euro crisis, is becoming increasingly probable. What's more, chances are rising that the currency will not survive the coming years. There is no easy way out of the European government debt trap. Sooner or later, someone will opt for a severe haircut, and then all hell will break loose with the euro. In the United States, there is widespread unwillingness to accept the unavoidable as well. And the US has even more at stake because the dollar is the world's reserve currency, and losing that privilege would be a major long-term loss, not only for the economic well-being of the nation, but also in terms of global dominance. For that reason, I think American politicians will eventually return to sound fiscal and monetary policies. However, it is not clear when that time will come. And that's why I am a long-term dollar bear and a long-term euro bear. This, of course, means that I am a long-term gold bull. The same fundamentals that impede fiat currencies support the gold market. Therefore, I suggest investors consider taking a long-term strategic gold position in an exchange-traded fund, such as GLD, until a major policy change comes about, whenever that may be. But in the short term, there may be some opportunities in paper currencies as well. For example, the dollar's recent decline against other currencies seems somewhat overdone, and technical indicators are pointing to a rebound, at least for the next few months. So, if you want to get in on that action, now might be a good time to buy an ETF like the PowerShares DB US Dollar Bullish Fund, ticker symbol UUP. I'm Klaus Vogt with Money and Markets TV. Thank you very much for watching.